Gold has been trading very actively since the COVID crisis. Big swings in risk appetite drove interest rates and the US dollar to extremely low levels, while pushing gold, the ultimate reserve asset, to record highs. Since then, the recovery gained traction and gold retreated, investors favoring risky assets over more defensive assets. Interestingly, gold is usually considered to be thriving when inflation fears are rising, but not this time. This is due to the fact that it is more related to real rates than inflation expectations per se. Therefore, we can primarily attribute the recent 20% sell-off in gold to the sharp rise in real rates. Conversely, this is also what explains the uptrend observed since late March. Our view on gold over the medium term is negative. It is due to a combination of factors. The team remains of the view that the US economic recovery will remain strong for a prolonged period of time. Our nowcasters demonstrate that economic activity is way above potential, and the improvement in unemployment triggered by a full post-COVID reopening will help sustain the second phase of the recovery. As a result, the US Federal Reserve will start to communicate about its exit strategies in the next few months, which we believe will push nominal and real rates higher, as well as the greenback. The combination of strong growth and high inflation for longer, low risk aversion, and central banks' shift into the direction of less accommodation will weigh on the price of gold, and this is why we expect lower gold prices over the medium term. Clearly, either a slowdown in the recovery or the Fed maintaining liquidity injections at the actual level for longer than expected. A resurgence in COVID cases could weigh on growth and delay monetary normalization. Real rates would stay low in this context, supporting gold. Otherwise, there is still a possibility that in spite of monumental growth and very high inflation, the Fed could decide to keep extraordinary accommodation in place for longer and manage to slow the rise in rates and the appreciation of the US dollar. The size of its balance sheet has quadrupled since QE1 in 2009 and 2010, reaching 8 trillion, and make things way more complicated for policymakers to let rates and debt servicing costs rise meaningfully.